What's going on YouTube? In this video, we are going to talk about Fastenal Company, ticker symbol FAST. Year to date, Fastenal is up 14.78% over the course of 1 year, 15% up. So Fastenal, together with its subsidiaries, engages in wholesale distribution of industrial and construction supplies in the United States, Canada, Mexico, North America, and internationally. It offers fasteners and related industrial and construction supplies under the Fastenal name. The company fasteners produces include threaded fasteners, bolts, nuts, screws, studs, and related washers, which are used in manufactured products and construction projects. So they make hardware for really probably everything. So we're going to take a look at their financials here. So we can see our revenue, gross profit, and net income. We are all three are trending in the upward direction. Always good to see. Net income, separated from the revenue and gross profit here, we can see this a little bit more clearly, and we can see that again, still trending higher. Gross margin is slowly, ever so slowly declining. However, our net margin is ever so slightly increasing. It is now above 15%. So that's pretty cool. 15, 15.6. So really consistent too. Not just a fluke, but it's consistently sitting at about 15%. Revenue and gross margin year-over-year change. Still looking for some growth here, but not a whole lot, right? We're 3.7, 2.7% gross profit increase. And then over here, we include our net income in terms of growth. Net income is looking like it's going to grow with the rest of the company here, 3.3, 2.7, 3.7. So, nominal growth, but there is growth still in this company. Return on invested capital, solid return on invested capital in this company. I mean, the mid 20s is fantastic. Cash to debt, debt was climbing quite a bit here. Obviously, now we have turned, at least recently, and must have been paying off some debt. And we can come up here, our total current liabilities, pretty flat. Our non-current liabilities also pretty flat. So really, we don't have a lot of debt on this company. So it's pretty nominal in terms of debt. So we've only got $244 million in cash on the balance sheet, $1.2 billion in debt. So not a big, yeah, only 224 million. Yeah, that's all we got. One thing to note here is the inventories. Uh, they're growing, but maybe not at a concerning rate. Obviously last year could have been an anomaly year, obviously because of everything else that was going on, but really flat over the last, sitting right around 1.5-ish billion in inventories. So nothing too concerning there. Stock-based comp, pretty flat. Still a little bit of stock-based comp going on. So I don't see too much to be worried about up here. Cost of revenue is increasing though, but again, it's not really impacting our net margins or anything else like that. Net income to free cash flow, looking good. Here's our net income trend, and our free cash flow is following suit. Free cash flow, nice free cash flow growth rate, just continuing to, generate more free cash flow. Nothing wrong with that. Our share count dilution just kind of staying flat. I mean, they are buying back a little bit of shares, but relatively nominal amount. Their dividend. This could be concerning for some dividend investors as to why their dividend, they had to cut back some of their dividend there. That makes you feel less secure about their dividend if you're investing into this company for that reason, right? Capital expenditures, again, pretty flat. These financials look, based on the charts and everything here, look very good, very stable, very consistent, just a slow growing company. Only concern I have is just their dividend here. Otherwise, everything else to me looks pretty good. Pretty good over here. We have FERG, URI, and GWW is our three comparisons we will be working with today. Two concerns over here on, two red flags, I should say, on Fastenal is our operating cash flow is higher than our net income. I always want to look deeper into why our operating cash flow is higher than our net income, because somewhere along the lines, once we got into operating cash flow, they increased the amount of income, right? Because on their cash flow statement, they have net income for the top line. By the time they get to the operating cash flow, all the cash that moved within the companies is between net income and operating cash flows, they added more money. So you want to know why and where that came from. Are they selling stuff? Are they selling machinery? That could be a problem, a red flag, or there could be something else in there that isn't too isn't too big of a deal. Now, our difference here is 1 point or it was like $130 million. So it's not a big difference. It could be just SBC, something very nominal like that. To me, this isn't a big concern, but it is just something worth looking into a little bit deeper to know, okay, what is that change? And you know what? Here, I'll let's bring it up right now. So I pulled up their cash flows from their most recent earnings statement here. We're on 6 months ended. We can also look over here too. But the difference to me, what I'm seeing right now immediately, we have an increase in depreciation of property and equipment and also an increase in inventories, which we saw the inventory increase. Actually, it was decreased, but that was over trailing 12 months though as well. So trade accounts receivable, basically, if you just disregard, those two numbers combined, they're not really related to each other at all there. But so you just figure 84 million. We're talking $97 million difference in our to our cash provided by operating activities. So no red flags there to me. Just a little bit of an increase that the company was able to claim on their operating cash flows there. And the other thing here, analysts forecast this company at $53 per share, and we're currently trading at $54.40 per share. So based on analyst expectations, we're already trading above their price target. Then over here, we have our market cap and revenue. Revenue's on the right-hand side, market cap on the left-hand side. So in terms of market cap, all four companies are within each other, within line, right around that 30-ish billion dollars. Fastenal here has the lowest revenue of the four companies. So revenues, gross profit, and income in order here. So here's our revenue. We already saw Fastenal has the lowest revenues. Gross profit, lowest net income as well. 5-year growth rate. This one's kind of get throwing everything off here over on Ferguson because they got 2,000% increase. But we can kind of see on percentages here that Fastenal is looking at 9 and 8.5% growth rates. The other companies here, 12.8, 7%, 6%, 7%. So all within the similar range here in percentages. So then we got our gross margin. Uh, Fastenal's got the best gross margin. Our operating margin here, Fastenal's still, I mean, even though it's in second place, it's still a pretty good operating margin there. Profit margin, Fastenal, right in line with Uri, basically. Free cash flow, even though Uri's got a better operating margin and better profit margin, it's got the lowest free cash flow. So that would be a company that I would not be interested in looking into more. However, Ferguson though isn't looking too terrible, but it doesn't have as good of a margins as Fastenal does here. But GWW here, in terms of margins, it is falling behind Fastenal overall. So in terms of what I'm seeing here, I see Fastenal as the leader of these four right now for how the business is ran anyway. Return on invested capital, I mean, fantastic. And our PE. So this kind of tells you what other investors are seeing is they're willing to overpay for this company, probably because its margins are very good, very sustainable, very consistent. They're holding those margins. They've got a growing free cash flow. There's really nothing to dislike about what we've gone through so far. It looks really good. All right, over to our calculators. Our Peter Lynch valuation gives us a 13.94 or $13.94 per share. Our multiples comparison, $33.06 per share. Our PE, so we're going to take our market cap, subtract out our cash, add back in what we got for debt, and divide those three numbers, that number that we get, by our cash from operations. It'll take 25.6 years for this company to earn its current market cap plus debt. A little overpriced, but it's at that just reaching overvalued. Price to book, we're sitting a little higher than our 5-year average, sitting at 9.19, 5-year average 8.28. PEG ratio, very high PEG, although this is not a growth company, so that is not really relevant. Graham's valuation, we're sitting at, Graham gives them a 27.16, we could probably give them a 2 because this is a very just slow growing, mature company. So we'll give them a 2 on the growth rate there. So that gives us $39.50 per share. So I also added in a dividend discount model because this is a consistent dividend paying company. So we have our stock price discount rate and dividend per share about $1.24. And I averaged our growth rate over the course of the last 9 years and came up to 7% growth rate. Discounted cash flow gave them a free cash flow growth rate of 15%. That is about what they have averaged. Analysts have them at 17.4%, and our discount rate is 9.36%. So we can look at our free cash flow growth rate is just has grown very nicely. Obviously had a little bit of decline in 2022, and hopefully they can continue that based on their free cash flow growth rate. I think they can do that. That gives us a discounted cash flow price per share of $32.71. Down here, Rule 72, we have our EPS, current PE. We have three EPS growth rates from three different sources with an average of 7.77. 7.77 goes into 72. 9.26 times 9.26 goes into 10 years, just over 1 time. So that gives us a future EPS of 4. Because what we'll do is we'll be able to double our current EPS 1 time, which gives us 3.92. So I rounded up to 4, which gives us a fair value of $15.54. 30% margin of safety of $10.88. So here's our final valuation of Fastenal here. We've got all 6 of our valuations that we just did that gives us a price tag, and that gives us an average fair market value of $30.24 per share with a purchase price of 30% margin of safety of $21.17 per share. So something to keep in mind too, we do have an analyst price target of $53.14. So analysts are pricing this company currently at, basically where it's trading slightly above right now. And the valuations that we got on this company are telling us that the company is not worth $50 per share. It's telling us it's closer to $30 per share. But based on the financials, this company might always trade at a premium to where $30 is probably the best deal you might get if it pulls back. Over here at the stock chart on Fastenal, kind of see over the course of many years, this company has just been in just a very just in this uptrend, just kind of hanging out. Just popped above. Now it's kind of retested the top end of this trend line that's drawn in here and pulled back, retested the lower side of it, and it's just kind of resumed higher here. So I mean, looks to me like what's possible on Fastenal is it might bleed down. Hopefully it can bleed down to like maybe 50-ish dollars per share here. And at $50 per share, that's still really far away from our fair market value on this company. I think this is one that you just kind of trade based on technicals, not really on fundamentals as much because there's not, I don't know. I don't know. I think Fastenal is interesting. I think Fastenal is really just a technical trader. I don't think this thing's going to trade much on fundamentals. So I mean, it's got a decent dividend. I think it's got a 1.4% starting dividend yield on it. Nope, it's got 2.58% dividend yield on it. So, I mean, it's a good starting dividend yield. And then, I mean, over the course of history, this company just continues to grow and continue higher. Let's look at the monthly chart. Yeah, I mean, this thing it's just in a straight uptrend, really, over the course of since 2009. It's just trending higher. So but that's it on Fastenal. Nothing for me personally. I got nothing against the company. I think it's got great financials. I think it's got growing free cash flows. The only concern is the dividend. Otherwise, everything else on this company just looks good. The only thing that's unfortunate is it is trading, in my opinion, based off it is just too expensive. If it pulls back to $30 per share, it might be a good buy. It probably is a good buying opportunity on Fastenal. I don't think you'll ever see $21 per share in this company unless something happens. That if something happens, you've probably got bigger things to worry about than what this company is trading at. If it's trading at $21 per share, it hasn't traded at $21 per share in since 2018. So maybe this is one of those stocks where you just trade off of technicals and not fundamentals, and that's the way it is. You just place your stop losses where you feel necessary, and like if I was to trade it, I would probably place a stop loss of $44 per share. And if it hits that, it's probably going much lower. At least down to $35 a share, maybe even down to like 30-ish dollars per share. But yeah, Fastenal just overpriced, solid financials, but that'll do it on Fastenal. If you found value in the video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.